Amazon is up 47% year to date. It is one of the Magnificent Seven, as Jim Cramer, our good friend, sarcasm, by the way, called that. I actually do think it's a great name, the Magnificent Seven. Amazon, though, up 47%. But guys, I want to show you something. There was a time when Amazon was considered untouchable. All-time high in July of 2021 of $188 per share. Just 5-6 months ago, it was at $81 a share. That's down almost 60%, or maybe it is 60%. People said there's no way Amazon's going to go that low. I say this to remind you that all great companies with a lot of hype will eventually come back to normal. It's still down. Current price is $126 or so it's still down from its all-time high by a third. Mm-hmm. But let's go check this out. In this video, we're going to go over bull and bear cases, some news, analyst estimates, our 8-pillar process, showing you guys Amazon from an 8-pillar perspective. And then we're going to culminate it with going through our stock analyzer tool to make assumptions about the future to determine what price to pay. So watch the entire video. Whether you're a beginner investor or an advanced investor, we're going to talk about a lot of things. Don't get overwhelmed. It's all part of learning, but you have the access here. We have over 2,000 videos there here on this channel that you can sit there and rewatch and learn from. So let's go over $1.3 trillion market cap. I forgot about that.
Yeah, me too.
Amazon, $1.3 trillion. This is if you bought every share outstanding, guys. Every share outstanding, that's what you're paying. All right, PE, a crowd-pleasing 301. A 5-year PE of 86. Guys, one thing I want to mention.
301.
I believe AWS makes up pretty much 100% of their profit.
Yeah,
Yep. You guys have to understand that when you're looking at a company. You got to understand everybody thinks, Amazon is everywhere. Yeah, it is. But if they're not making a ton of money off of every aspect of they for many quarters, they've lost money on their main business, which is retail sales. Yeah. We sell on Amazon through a few companies. They just increased our fees from 15% to 17%. They're starting to increase a lot of fees there because they're not making money on the retail portion.
Remember we were in the car the other day and I was like, oh, look at this. They're talking about for Amazon Prime members, $1 for every return.
Yeah.
Instead of free returns.
And by the way, I don't blame them for that.
I don't either.
But you got to remember that at some point the cash flow does matter.
Yeah, and clearly in their moves by saying $1 or increasing from 15 to 17, it matters to them.
It matters. Well, let's look at their profit margin. Last year, 0.8%, and their 5-year average is about 4%. So that's with AWS. Let's look at Walmart, the company that everybody says that Amazon completely crushed. Profit margin, 2.1%. Pretty low. These are very low margin businesses, and that's my point. Amazon is a retailer. Now, do they have AWS, which is a high margin business? Absolutely. But with high margin comes a lot of competition. Microsoft, Google, Alibaba, everybody in this world has some sort of cloud computing now. Does Amazon lead the way? Absolutely. They absolutely lead the way. But when there's high margins, it's going to bring in a lot of competition, and you have to remember that.
For now, they lead the way.
Yeah, I don't know what's going to happen in the future.
Yeah. Very
low return on invested capital. However, 8.3% over the last 5 years. However, they're still reinvesting a lot of money. I saw a report recently that said, let's go look at their cash flow statement to see how much they're reinvesting in their business. Look at their capital expenditures, Mo. 10 years ago, it was $3.8 billion. Last year, it was $63 billion. The year before that, 64. The year before that, 45, then 20. Guys, they are big believers in investing in the future. That is something I will absolutely give credit to Amazon for.
They've always been that way too.
They've always been that way.
Yeah.
And absolutely pays off. However, I still believe at some point you got to sit there and say, where's the margin going to come from? This gross margin is 13.5%. Where's the margin going to come from? Walmart's gross margin is like 25%. At some point, you got to be able to make a lot of money. At some point, you got to be able to make a ton of money where it's justifiable. So Mo, why don't you go through some of our bull and bear cases, and then we'll check out our 8 pillars.
So 2 major news things.
Oh, news, that's right.
Yeah, so number one, they've invested about $8 billion in Ohio in data centers. So we are back.
We are back.
Amazon Web Services has decided to invest $100 million into AI innovation. So I feel that by the end of the day, this should be a $300 stock for that reason. They said AI.
Of course.
Why not? Partnering, bull cases now. Amazon is partnering with Rivian to take their technology into Europe. I feel like they need to work on the United States first before they do that, but that's
well, they have
just
some
me.
Rivian. They have Rivian trucks here in the United States. You know, when I see,
I'm starting to see more of them.
yeah, and Amazon has an investment in Rivian, and it's up 40% recently. Okay,
Yeah, I'm not sold on this Rivian thing, but global cloud market is expected to grow at 20% CAGR from 2022 to 2030.
and guys, for those who don't know, CAGR means compounded annual growth rate. So they're saying 20% per year until 2030.
Yeah.
And Amazon holds 32% of the global market share.
Exactly. So that's huge.
Guys, we use AWS for everything money and for Dynasty Owner, our fantasy football game. That we use AWS. AWS is wonderful. It's great. It's great service, right, Tim? So there's no denying that. But again, there's more competition as these companies get into higher margin businesses. Mo, give us some bear cases.
So bear cases, and I almost see this as a bull case, ending a partnership with Silver Airways, who flies their cargo planes. They have no plans to replace them. I almost think this could be some type of cost savings area.
Maybe so.
Then, of course, going with Starbucks and Amazon and what they're all doing, there's union threats. So the Teamsters Union won $30 per hour contracts this year for delivery drivers. So, of course, the union stuff starts to get involved as the bigger you grow.
Guys, if you think for a second that these unions don't cost a lot of money, just wait till you start seeing what the costs are going to be.
Yep.
Just wait.
When you start doing this, this is when your free returns go to $3, $4.
Profit margin.
Yeah, that starts to go down.
Guys, they don't have how many employees does Amazon have right now?
I thought isn't it like 600,000?
1.5 million employees. How many of them are drivers? 275,000 drivers. Okay, let's do some math real quick.
Wow.
275,000. What do they make right now? There's no way.
Ohio,
It's 1774. Okay.
That's in Ohio.
That's in Ohio. Let's say
based
the
on
average
Indeed.
is 2250 overall for the entire country. So now going to 30 would be a 750 increase. So
That's a
times
huge
7.5 times 40 hours a week times 52 weeks out of the year. $4.3 billion. $4.3 billion. If you want to sign a 20 PE to Amazon, that's $86 billion in market cap. You might sit there and say, big deal. It's only 5%. It's only 7%. Okay, that's fine then.
Yeah, but as they start doing more of this, and by the way, you're going to start, the Teamsters are going to start there, then they're going to move into the warehouse, then they're going to move into this place, and it's just an endless process. This is a good one. You'll
and then
like this.
It's only going to cost one group of people more money, consumers.
Yep.
Go ahead.
They've announced a $10 billion buyback.
Oh, 300 PE.
Yeah, so that's really good.
86 5-year PE and a $10 billion buyback.
Now, guys, listen to this. These are stock price falls over the past 23,
Since they
24
gone public.
years. Yes. April 1999 to September 2001, the stock fell 95%.
I've brought up this exact point in many videos saying, guys, Amazon fell 95% in the dot-com bust and they still survived. The point I was trying to make, and people say, oh, look, it survived. But you wouldn't have been the person who wrote it all the way down. If you'd like to think you would be, if you don't buy based on fundamentals, you're going to bail the second the stock turns on you. The second the stock turns on, you're going to bail. That's why we're trying to teach this process, so you can be the better investor. So you can sit there and say, no, I think Amazon is worth X number of dollars per share. If it goes down, I'm getting a better price. I'm going to buy more shares. But if you're only buying based on the ticker going up and down, you're going to have problems. Mo, tell us some more.
Again, January 2008 to November 2008. So at this point, you can say the tech boom was over. People started to know what Amazon was. They fell 64.5%
In 9 months.
in 9 months, from
Next one.
$4.87 to $1.73. Next one, November 2013 to October of 2014, it fell 28%.
Skip to the most recent one.
Most recent one, November 2021 to December of 2022, it fell about 57%.
Guys, I want you guys to know something here. Look at this. Every single one of these, except for the dot-com one, was less than a year. So when people say like, oh, it's not going to happen that quickly, there's 1, 2, 3, 4 times in the last 15 years, the stock in less than 1 year fell huge amounts of money.
Yep.
Okay,
Yep.
It's possible. That's what we're trying to say. So if you buy a stock at a good price and it falls, and if you know what the good price is and it falls, you look at it as an opportunity to buy more.
And that's the important part. It fell 64% in one case, and look where it ended up, $188 a share. I mean, these companies do recover from these falls, but you just have to have the stomach to stick with it.
And you have to be able to pay a decent price where you know what you're buying is good value.
Exactly.
All right, so let's go to our 8 pillars on Amazon.
Right.
Ooh, remember guys,
Bad.
if you have our software, you can customize up to 12 pillars here, and there's 4 quadrillion or so variations of our pillars. I stick with the original 8.
I have 3
Mo
in
has
here.
his 3 separate ones. Okay.
And I change these all the time.
Only 1 check mark.
Yeah.
That's revenue growth.
Yeah.
Guys, I don't know. You would think that in 5 years with this much revenue growth, cash flow, but net income. So here's where I get concerned. I can understand this cash flow problem, right? Because they invested a lot in CapEx, right? They increased their capital expenditures by a ton, over triple. But I don't get this net income because the net income is to explain this, it's going to be a little complicated. When you spend $60 billion in CapEx in 1 year, you probably expense it over a 5-year period or 7. So you maybe expense $12 billion a year. I don't get this, especially with revenue growth of this. That's what confuses me.
Yeah.
Now, guys, there's a lot of people out there who say, Paul, you don't get it on Amazon. And trust me, I don't get it on Amazon. And I just wonder why this is the case.
This is an anomaly. This really is.
I mean, this thing has been crazy for a long time.
Yeah. Hey, I mean, you have a company that's worth $1.3 trillion that looks like they're $1.3 billion company in a growth phase, the way that they operate.
And the way the numbers are, yeah.
That's why they're such an anomaly.
Yeah, it's
and
crazy.
if you look in the book 100 Baggers, they talk a lot about Amazon as a case study. It's very interesting.
All right, let's go to analyst estimates. They're expected to make $1.44 this year per share, growing, though, to $6 in the next 5 or 6 years.
Okay.
Look at that growth level. Huge growth. But, again, they should have huge growth because they're investing a lot today. Let's look at revenue. $567 billion estimated this year, going to $887 billion. Okay, double digits. Great, good stuff. And again, though, guys, don't take analysts they have the biases that we all have. They have immense bias, actually, because they have to sit there and be part of the crowd.
I'm sure none of them were this excited when it was $88 a share.
Yeah, look at NVIDIA. All of a sudden, now we're seeing upgrades to NVIDIA's stock price. Why? Because the stock is skyrocketing. I was just telling my brother today, we're talking about the markets, and I said to him, I go, Mikey, imagine if we had investors. He's like, what do you think? I'm like, it would be awful. They'd be telling me, why don't you have NVIDIA? Why don't you have this? Why don't you have that? That's why it's great that we're the only investors we handle. Mm-hmm. So we can be okay in owning companies we love at the price we love and underperform the market for periods of time. I'm okay with that. I'm absolutely okay with that. Now, stock analyzer tool. So guys, this is our stock analyzer tool, the most popular part of our site, used 1.3 million times last year by our users. And if you want this tool, in addition to all the other tools up here, including our real estate calculator, which is included in our plan right now, but by the end of the month, it'll probably be its own separate plan. So sign up today. $7 for 7 days. You get all of these tools, including the real estate calculator. You'll be grandfathered in, and you get the community of thousands of like-minded investors where you can go in there and chat, because it can be a lonely, lonely road when you invest, especially if you're not around people who are like-minded. And guess what? When I say that, people disagree with me on Tesla, about crypto, and all these things in there. It's a good, engaging conversation. So come on in. $7 for 7 days. Go to everythingmoney.com. Mo, let's do our stock analyzer tool for Amazon for a 10-year analysis. Hit me up here, buddy.
So I'm between 2 right now. You decide 6, 8, and 10, or 7, 9, and 11.
How about 5, 8, and 11?
Fair. Run the gamut.
Yeah.
All right. Profit margins is so hard to do.
Can I do profit margins?
Yes.
I'm going to do
free
3,
cash flow,
5,
too.
and 7.
Wow.
Okay, now here's why.
Okay.
I think they should be able to hit 3.
Yeah.
And with all this investment here, maybe they get to 5. I actually could do, you know what? I'm going to do 3, 6, and 9.
Wow.
Here's why, Mo. Because I want to sit there and see, like, what would it take? Like, are they really, like, if this really high one hits, what is it worth? Mm-hmm. Because that's the big key here. I always want to show these, like, really extreme examples sometimes.
So the only thing is, when you said, let's see if their investments work, their investments have been working, and they're still at 3.8% over 5 years.
Yeah.
And that's why I'm like, oh,
But
really?
they keep increasing their investment
That's
amount.
true. That's
So
true.
I'm going to give them the benefit of the doubt there.
That's true.
Guys, but keep in mind here, in the last 10 years, they've done 3.2% profit margin. In my middle assumption, I'm putting 6, which is almost double that.
Yeah.
In my highest assumption, I'm doing 9, which is almost triple that. All right, free cash flow.
Why don't you do that one?
I'm going to do 2, 5, and 8, because they've trailed a little bit on the free cash flow.
Okay.
Now, PE. Now, guys, if you're a fan of that idiot out there, meet Kevin, where he thinks a 300 PE means a discount's 100, well, then I can't do anything for you. This is what I would do. We start at 15 on PE because the market average is 15. We go up for a high return on invested capital, which Amazon's was 8.3%, which is below the historical market, and a high growth rate, which they have. And then we go lower if the opposite occurs. So Mo, give me your PE for Amazon. Is this a moat business? Is it not a moat business, et cetera?
Yeah. How about 17, 20, and 23?
Way higher than I would have done, but I love it. I would have personally done 15, 18, and 21.
Okay.
So Mo's giving a premium, a 33% premium in the
giving
middle
him a premium.
to the market's historical average, which, okay, I'm sure a lot of people agree with him on that one. Desired return. Now, guys,
Oh boy.
when you do desired return, this is your margin of safety. The higher your assumptions, the higher return needs to be because it's less likely to happen. And, all right, Mo, go for it.
How about 11, 14, and 17?
I love it.
That number is high on the high side.
Guys, I went to insane mode here. I have to have a high margin of safety here. I have to get a 17% return to do this.
These numbers are going to be ridiculous.
So I'm going to hit the
Compared to
analyze
today's
button, guys.
prices.
On the analyze button, there's going to be 9 numbers that pop up, but they're going to be very simple. We're going to go through them. Make sure you stay through the entire video. There's only like a minute left. Stay through the entire thing because I'll explain these numbers very thoroughly. Boom.
All right.
A low price of 16 to 25, a high price of 83 to 94, mid price of 50 to 55. It's on my watch list of 50. Guys, this shows you how expensive the company is. If you paid today's price of 127 and the low number occurs, you're going to lose about 12% per year.
Wow.
If you pay today's price of 127 and the middle numbers occur, you're going to make about 1.5%. And if you pay today's price and the highest numbers occur, you're going to make 11.3. So just to get a market-beating number, the numbers that have to happen are insane. Triple the profit margin, double-digit growth, triple the free cash flow margin, and a 23 multiple. That's why we do this. So guys, go to everythingmoney.com. This will change the way in which you look at stocks and companies. I guarantee you will love the software. $7 for 7 days, everythingmoney.com. Thank you for your time.